Howdy, Jacob here. Today we're looking at SEI Investments company 110 of our high ROIC screener, capital markets industry, 9.3 billion market cap on 8.4 billion enterprise value. Been around since 1968, based in Pennsylvania. It looks like through its subsidiaries, the firm provides wealth management, retirement and investment solutions, asset management, all that fun stuff. Okay. Growth is not very sexy, 1.3 billion in 2014 to 1.9 billion in 2023, but it is pretty consistent. Outside of this year, we were seeing just very consistent mid-single digit growth, high return on invested capital, very low difference between return on equity and return on invested capital means that there's not a lot of debt. Margins are relatively flat on gross margin side and actually down quite a bit on operating margin side. Let's look at that balance sheet. So 835 million cash on hand with 388 in all of their liabilities, zero long-term debt, zero short-term debt. We're very comfortable with this balance sheet, very safe investment. Cash flow has capital expenditures roughly the same as 10 years ago, and cash from operations is up a little bit. So they are producing a greater amount of free cash flow, which is good. The use of cash seems to be maybe 50 to 60% share repurchases, maybe 25 to 30% dividends, a little bit of reinvestment, a little bit of acquisitions. So majority of their cash is being paid out to shareholders through common stock and dividends, which is great. That's how you immediately get to see the return. Dividends, obviously, you just get the money in your account through dividends. Then share repurchases, at least you want them to be buying back shares at a cheap price, since that's going to give you the maximum return possible. But I mean, just buying back shares will offset the market cap all else equal. Obviously, the market cap is based on the supply or the demand and such for the stock, and it's on a day-to-day basis a bit wild, but in reality, buying back shares should give you excess return on your investment. But again, like I've said in a bunch of other videos, there's other things you can do with this cash flow. So you want them to be doing what's absolute best, giving you the maximum return possible. If they're buying back these shares, giving you a 5% return, that's not good. You'd rather them reinvest that into themselves at these 20 plus rates of return that they've been able to do historically, or pay you a dividend, which is going to give you, 8 to 10% probably, acquisition, depending on if it's making your, acquisitions are great if it's making your company more efficient, higher margins and everything, not just to grow revenue, but we want to see margin expansion and heavier growth with acquisitions through leveraging those products to maximize your own. But right now, we just see share purchases and paying out a dividend. Nothing bad about it. Just saying those are the facts, and trying to think through different ways that they can allocate that cash to maximize it. But I think I'm ready to make some assumptions here. I think the growth side is not going to be very crazy. I think 3, and then I'm not putting that large of a premium, 14 on the P and price to free cash flow, because although they have a high return on invested capital, we see that they're not really reinvesting that much back in the business. So if you had a 20% return on invested capital and reinvesting all of it, I would obviously be putting a premium on your P and price to free cash flow due to the fact that you're going to have excess returns well above the market. But here we're seeing that they're paying out 70 to 80% through their dividend and share repurchases. That's not giving you that reinvestment. That's not giving you that 20% reinvestment. And so I didn't put a premium on their P and price to free cash flow. This is just a little bit under the market average based on the fact that I think their growth after 7 years will probably be a little bit less than market, maybe right on tune. But I don't think it's going to be growth is going to be that sexy. And again, based on the return on invested capital, not totally reinvesting back in themselves, I think I'm comfortable with that. And then for margins, let's go pretty close to averages here. Maybe let's do 27 and 29%. Then buying back 2% of shares would be about 180 million. And 180 million seems to be something that they can absolutely afford. For the dividend, it's paying out 25 to 30%. I mean, they can afford that. And let's say they grow it relatively in line with their revenue growth. And we see that these assumptions are saying that they're still leaving about 20 to 30% of their free cash flow to reinvest, make acquisitions, and that's going to be seen through this revenue growth and everything and these margin numbers. So we're just seeing that it's a little bit expensive at this price currently, based on my assumptions. Do your own analysis, see if it makes sense for you, but hopefully you enjoyed the video and my very quick analysis just based on the numbers of SEI investments. So have a great rest of your day. Thank you.